The Intelligent Investor, Benjamin Graham. Few books have changed the investment game like The Intelligent Investor by Benjamin Graham. It's not a book of easy promises or shortcuts to get rich quickly. Above all, it's a shift in mindset. Graham teaches that investing isn't about chasing quick profits. It's about building wealth through logic, patience, and discipline. That's why Warren Buffett, one of the greatest investors of all time, declared that this book changed his life. Because it doesn't just teach you what to do with your money, it teaches you how to think about it. Graham's first lesson is brutally honest. Most people who call themselves investors are actually speculators. They buy stocks based on hunches, headlines, or trends. They ignore fundamentals, don't understand the business, and react emotionally to the market. That's not investing. That's gambling. And frequent gambling in the financial markets often ends like it does in casinos, long-term losses. The intelligent investor, by contrast, ignores the noise and focuses on value. They understand that markets fluctuate, but the real value of a company is what supports the investment. Graham introduces the concept of Mr. Market, one of the most powerful metaphors in the book. Imagine you're a partner in a business. Every day, your partner, Mr. Market, offers to sell you his share or buy yours, with wildly fluctuating prices. Some days he's optimistic and prices are high. Other days, he's pessimistic and prices plunge. Your job isn't to follow his moods, but to take advantage of them when he becomes irrational. A true investor isn't manipulated by the market. They use the market to their advantage. Buy when prices are below intrinsic value, and sell or hold when they're above, based on fundamentals, not emotion. Another key concept is the margin of safety. Investing always involves uncertainty, but you can protect yourself by buying assets well below their intrinsic value. It's like buying a $100,000 car for $70,000. Even if it loses value, you have a cushion. Graham insists that the margin of safety is the cornerstone of intelligent investing, because the future is unpredictable and even the best analysis can go wrong. That's why the entry price must provide protection. The distinction between the defensive investor and the enterprising investor is another pillar. The defensive investor seeks safety and stability. They're not trying to beat the market. They just want solid growth. They invest in large established companies, diversify, keep costs low, and avoid frequent trading. The enterprising investor, on the other hand, devotes time, study, and analysis to find opportunities with higher upside. But this demands preparation, emotional discipline, and deep knowledge. Choosing between the two depends on your profile, but one rule is clear: never invest in a rush or in ignorance. Graham emphasizes that the investor's biggest enemy is not the market, it's themselves. Emotions like fear, greed, anxiety, and euphoria lead to irrational decisions. Buying at the top out of greed, selling at the bottom out of fear, changing strategy because of headlines. All of this undermines long-term growth. The intelligent investor builds a plan, defines rational criteria, and sticks to it even when the market screams otherwise. They understand that volatility is part of the game, and that patience wins. The book also stresses the importance of understanding a company's fundamentals before investing. That includes knowing its earnings, debt, management history, industry, and growth prospects. Graham states that stocks are pieces of businesses, not just numbers on a screen. Investing without understanding the business is like getting married without knowing the person. The price may look good, but the risk is huge. Optimized insights. Part 1: speculating is not the same as investing, and most people confuse the two. The market is your servant, not your master. Emotion and money don't mix. Rationality is protection. Margin of safety is the only real antidote to forecasting errors. The defensive investor seeks stability, not adrenaline. The enterprising investor is disciplined. Not impulsive. Price is what you pay. Value is what you get. Knowing the business matters more than tracking charts. Volatility isn't the problem. It's opportunity in disguise. Having a plan matters more than being right. Short-term patience is the secret weapon of wealth. Building financial intelligence is 90% emotional, 10% technical. If these principles are already changing the way you think about money, just wait for the next part. We'll dive into how to apply this philosophy in practice, build a solid portfolio, and protect your wealth from common mistakes. If this content is making sense to you, make sure to subscribe to the Optimized channel. Here, we build wealth with intelligence, not haste. See you in part 2. Investing intelligently isn't about predicting the future, it's about protecting yourself from it. Benjamin Graham shows that the true investor operates with clear, consistent, and rational rules. They're not chasing extraordinary profits. They're aiming for solid, predictable, and sustainable returns. To achieve this, the investor needs a system, and that system starts with balanced allocation. Graham recommends dividing the portfolio between stocks and fixed income. The proportion varies with your profile and the market cycle, but it should never lean entirely to one side. Diversification protects against uncertainty. It doesn't eliminate risk, but it distributes it. The defensive investor should focus on large companies with a stable history, good governance, consistent profits, and controlled debt. They avoid trendy picks or hyped startups, preferring solid companies, even if their growth is slow. They understand that the secret to wealth isn't hitting the next apple, but avoiding the next disaster. The enterprising investor, meanwhile, can allocate part of their capital to more specific opportunities, as long as they use strict criteria for value analysis. They study, calculate, compare, and then invest. For Graham, the market is a daily auction of emotions. But the investor doesn't need to be the smartest, just the most patient. Graham debunks the myth of outperforming the market. He proves, with data, that even experienced professionals rarely beat the index in the long run. This means the average investor doesn't need to take extreme risks or try to time the market. They just need to follow a strategy that works consistently. Buy good companies at reasonable prices, reinvest dividends, keep costs low, and hold for years. This, done with discipline, outperforms most market timing strategies. Another crucial point is emotional shielding. When markets drop, the media panics. Headlines scream crisis. Investors sell in fear. But that's precisely when the intelligent investor stays calm. They review fundamentals, assess if prices have dropped below real value, and, if there's a good margin of safety, they buy. Not because they're optimistic, but because they're prepared. Graham teaches that emotional discipline is more valuable than any technical trick, and that the greatest financial mistakes come not from lack of knowledge, but from lack of self-control. Graham's philosophy also discourages constant trading. Buying and selling frequently raises costs, increases risk, and compromises returns. The intelligent investor buys with the intention to hold. They know time is capital's greatest ally. That compound interest grows exponentially over the years, and that often the best action is inaction. They don't measure success by portfolio movement, but by consistent long-term outcomes. Lastly, Graham warns of the danger of predictions. He asserts that no one, absolutely no one, can predict the market with accuracy. Those who try, fail. Those who succeed once, fail the next time. That's why he advises investors to ignore economic forecasts, stay away from financial gurus, and avoid reacting to short-term noise. Intelligent investing is about the long term, about making decisions you won't regret 10 years from now, even if they seem slow today. Optimized insights. Part 2: diversification isn't a luxury. It's protection against the unpredictable. Defensive investors protect. Enterprising investors analyze deeply. Buy and hold beats buy and rush stocks are pieces of businesses. And businesses take time to grow. Long-term performance needs consistency, not brilliance. Emotion destroys profits more than any crisis investing. is more about self-control than market control. Compound interest is the superpower of the patient. Impulse selling erases years of progress. The biggest losses come from quick reactions and poorly thought-out decisions. Market forecasts are distractions. Disguised as strategy, the intelligent investor knows when to act and when to simply wait. In part 3, we'll wrap up with principles for asset evaluation, how to calculate intrinsic value, and what Graham would say about today's investor mindset. If you're learning to think like a true wealth builder, subscribe now to the Optimized channel. Here, we don't chase profits, we build them with intelligence. See you in part 3. At the heart of Benjamin Graham's philosophy lies a concept that separates amateurs from professionals: intrinsic value. Intrinsic value is what an asset is truly worth, based on fundamentals, projected future earnings, assets, liabilities, and the overall business outlook, regardless of the current market price. Investing based on intrinsic value is like buying a house for less than it's worth, knowing that over time, the market will recognize its true value. This requires analysis, patience, and independent thinking. 3 virtues the average investor rarely cultivates. To estimate intrinsic value, Graham recommends using solid metrics: earnings per share, EPS, price to earnings, PE ratio, book value per share, dividend yield, growth history, debt levels, and management quality. No single metric guarantees success, but together they provide a clear picture of a company's potential. The intelligent investor doesn't buy what's trending, they buy what's undervalued compared to its worth. And this difference is what enables wealth building, while most others get lost in speculation. Graham also reminds us that the market can take a long time to recognize a stock's true value. That means returns won't be immediate. So the investor needs conviction. They need to trust their analysis and resist the urge to sell too soon or panic during short-term dips. A stock's price is a reflection of collective emotion, but a company's value lies in its results. Distinguishing between price and value is one of the hardest and most profitable skills to master. In today's world, where investment apps promise fast returns, social media dictates trends, and cryptocurrencies rise and fall in hours, Graham's philosophy might seem old-fashioned. That's exactly why it works. Amid euphoria, discipline becomes a competitive edge. Amid noise, analytical silence is gold. Graham teaches that the intelligent investor doesn't try to look smart, they try to be sensible. They ignore what everyone's talking about now and focus on what will still matter years from now. One final crucial point. Investing is just one part of a larger wealth-building plan. Graham reminds us that invested money must come from a solid foundation, stable income, controlled expenses, emergency savings, and a clear life plan. Good investing isn't just about choosing the right assets. It's doing so within a broader life strategy. That takes more than technical know-how. It takes mindset. It takes maturity. It takes a long-term vision strong enough to withstand any short-term storm. Optimized insights. Final part. 3. Intrinsic value is the foundation of conscious investing. Buying below true value creates margin of safety and profit potential combined. Metrics reveal opportunities the market overlooks. Price is emotion. Value is fundamental. Conviction is more valuable than speed. The market can be wrong for a long time, and you can still win. Discipline outperforms brilliance in euphoric cycle stocks. Our vehicle's strategy is the destination. An investment plan without a life plan is an illusion. The intelligent investor thinks in decades, not days. Benjamin Graham didn't write for those who want quick wins. He wrote for those who want to preserve wealth for a lifetime. The intelligent investor isn't the one who guesses the next surge. It's the one who avoids the next fatal mistake. If you want to invest with clarity, protect your capital, and grow steadily, this book is your manual. And if this content resonated with you, subscribe now to the Optimized channel. Here, we don't follow the market, We follow timeless principles. See you in the next summary.